In the current financial landscape, the stock markets resonate with an air of optimism, fueled by the narrative of a Goldilocks economy and the tantalizing prospect of an impending pivot by the Federal Reserve. However, beneath this facade of confidence lies a disconcerting revelation emanating from the bond markets. The pronounced inversion of yield curves observed worldwide, a reliable harbinger of economic downturns, serves as an ominous warning that contradicts the prevailing optimism. This stark contrast between the buoyant sentiment in stocks and the ominous signals from bonds creates a palpable sense of unease among investors, prompting them to pay heed to the insights offered by all three key players in the financial arena: stocks, bonds, and the pragmatic voice of economic reality. Decoding the yield curve inversion is pivotal in understanding the underlying dynamics of the economy and anticipating potential downturns. The yield curve represents the relationship between bond yields and their respective maturities, with a normal curve sloping upward, indicating higher yields for longer-term bonds. Conversely, an inverted yield curve occurs when short-term bond yields surpass long-term yields, often signaling investor apprehension about future economic prospects. It's crucial to highlight that throughout history, inverted yield curves have consistently foreshadowed economic contractions by significant periods, sometimes extending up to a year or more. This historical trend underscores the importance of recognizing yield curve inversions as reliable predictors of economic downturns, prompting investors and policymakers to closely monitor these indicators. Furthermore, the urgency surrounding the current yield curve inversions stems from their depth and proximity to an impending recessionary event. Not only are the current inversions pronounced, but they also suggest that a rapid economic slowdown may be on the horizon. By drawing parallels to past instances, such as the inversion preceding the 2008 financial crisis, it becomes apparent that initial dismissals of the inversion as a temporary anomaly were misguided. Instead, the persistence and deepening of the inversion over time served as a clear warning sign of the impending crash. This historical comparison serves as a sobering reminder of the potential repercussions of overlooking yield curve inversions and underscores the need for proactive measures to mitigate the risks associated with looming economic downturns. Understanding the gravity of yield curve inversions provides a critical foundation for investors and policymakers to make informed decisions and implement strategies aimed at navigating turbulent economic waters. Understanding the intricacies of interest rates within economic cycles illuminates the intricate relationship between financial metrics and real-world economic performance. Despite common assumptions, interest rates often fail to immediately reflect the onset of recessions, leading to a paradoxical situation. Central banks, responsible for overseeing interest rates to manage economic activity, frequently identify downturns after they have already begun to manifest. Additionally, the initial strategy of raising interest rates during the early stages of a recession can inadvertently worsen the economic downturn by discouraging consumer spending and investment, amplifying the pressure on an already fragile economy. In the context of the broader business cycle, it becomes apparent that industries directly engaged in economic activities often serve as the proverbial canaries in the coal mine, signaling shifts in economic momentum before they become apparent in official data. Sectors like trucking and small businesses, intricately tied to consumer demand and investment trends, act as early indicators of impending economic slowdowns. However, a significant time lag exists between the onset of economic deceleration and the subsequent adjustment of borrowing rates by financial institutions. This lag results in a disconnection between the real economy and credit markets, where businesses face elevated borrowing costs even before the recession is officially acknowledged. Consequently, as the downturn deepens and becomes undeniable, lending rates eventually plummet as banks react by tightening credit conditions, exacerbating the economic contraction. The disparity between layoffs and official unemployment figures underscores the complexity of gauging the true health of the job market. Layoffs, often accompanied by severance packages, do not immediately translate into an uptick in unemployment rates due to the time it takes for affected individuals to re-enter the job market. As a result, there is a delayed impact on official unemployment figures, which may not accurately reflect the current state of employment. This discrepancy between layoffs and unemployment figures creates a deceptive illusion of stability in the job market, masking underlying economic challenges. Moreover, the notion of a hidden recession looms large as many sectors grapple with recessionary conditions while official unemployment rates remain relatively low. This discrepancy highlights the disconnect between headline economic indicators and the lived experiences of individuals and businesses. Similar to the lead-up to the 2008 recession, where a seemingly tight labor market obscured underlying economic fragility, today's economic landscape may be concealing deeper issues beneath the surface. This historical echo serves as a cautionary tale, reminding us of the dangers of relying solely on headline employment figures to assess the true health of the economy. The Federal Reserve finds itself caught in a challenging dilemma, prioritizing market stability over daily fluctuations in stock prices. Past interventions, such as those witnessed in March 2020 during the onset of the COVID-19 pandemic, highlight the Fed's tendency to step in when markets face disorderly conditions rather than gradual declines. In such instances, the central bank aims to restore stability and confidence in the financial system through decisive action, emphasizing the importance of maintaining orderly markets to prevent systemic risks from escalating. However, the Fed's potential pivot towards rate cuts represents a tacit acknowledgement of past policy missteps rather than a successful execution of its intended goals. While the central bank may resort to rate cuts to counteract economic headwinds, it often does so in response to an overly aggressive tightening cycle that inadvertently exacerbates economic challenges. The parallels drawn between the Fed's current stance and the events of late 2018, characterized by a sudden market meltdown prompting swift policy reversals, underscore the recurrent nature of these challenges and the Fed's ongoing struggle to navigate economic uncertainties effectively. Investors, regardless of their experience level and risk tolerance, face a critical decision amid the looming specter of an impending recession. For conservative investors prioritizing safety over returns, a strategic shift towards short-term treasuries and FDIC-insured vehicles like high-yield savings accounts offers a refuge from market volatility. Furthermore, considering laddered CDs can provide a means to lock in slightly higher rates over staggered periods, ensuring both preservation of principal and regular access to cash. Selective investment in blue-chip companies within recession-resistant sectors, particularly those with a proven track record of maintaining or increasing dividends during downturns, can offer stability amidst economic turbulence. Moderate risk investors, on the other hand, may opt for a balanced approach, leveraging a mix of recession-resistant stocks and bonds through balanced ETFs. These investors may also consider defensive sector shifts, increasing allocations to utilities, consumer staples, and potentially healthcare, sectors known for their resilience during economic downturns. Additionally, maintaining a portion of opportunistic cash, around 10 to 15%, allows these investors to seize discounted stock opportunities when market sentiment reaches its nadir. However, aggressive investors, willing to embrace higher risks for potentially greater rewards, may explore strategies such as inverse ETFs or put option strategies to capitalize on market downturns. Moreover, hedging with gold, though historically offering some portfolio diversification during times of turmoil, should be approached cautiously, given the evolving correlations between gold and stocks during crises. Regardless of investor profile, dollar cost averaging remains crucial, ensuring consistent investing through downturns, while understanding one's time horizon and conducting thorough research are indispensable elements in navigating the complexities of economic cycles. The contrasting narratives of bullish optimism in the stock market and cautionary signals from the bond market underscore the fractured state of the current economic landscape. The potential for a Federal Reserve pivot serves as a stark reminder of central bank overreach rather than a signal of economic strength. As investors navigate this uncertain terrain, it is crucial to recognize the likelihood of an impending recession, even if official data has yet to fully acknowledge it. Preparedness and vigilance are paramount as we brace for the challenges ahead in the face of looming economic downturns.